One side is the city of Tucson. That was a pain in the neck to get them to, sign up, right? So we had to deploy people who could call the mayor up and so on and so forth. We really had to push hard on that customer. It was a long sales cycle. Consumers, that's why they're coming to you, because they're trying to lower their cost of customer acquisition, because they have to buy you in essence, right? So they're playing the emotional angle and so on and so forth. They're trying to lower their cost of customer acquisition is actually what they're doing. Now put on your investor hats. Here is what we're saying. Guys, cost of customer acquisition was really low in Tucson. Now you're going to go to Phoenix. Cost of customer acquisition is going to go up. You go to Ohio, cost of customer acquisition is going to go through the roof. Do we have enough data that we can still make money even if the cost of customer acquisition goes up? The valley of death is this intermediate period, because once you have adequate scale, you have an adequate mass of people who are already using the Park Genius app, then the cost of customer acquisition starts coming back down again. Critical mass has been achieved. Cities are talking to one another. Oh yeah, I've been using the Park Genius thing for 6 months now. It's working beautifully. It increased our revenue by 20%. At that point, cost of customer acquisition comes down. So initially, Tucson, low cost. All of a sudden, very high cost, valley of death. And then, if you can reach critical mass, cost of customer acquisition is going to come down again. So those are the things that we're agonizing over as investors, whether to provide the funding for them to go through that next big stage. Exactly the same arguments for food and food, right? So there's two sides of this, the capital and the founders, and there's always a level of tension, a level of discussion, a level of persuasion, but as you can see, very upright citizens, right? They are people who deserve a chance. And so that's how you will be perceived also. They are students who deserve a chance to try this out, and let's see if they can succeed. So you'll be leveraging that. Your student play, you'll play your student card, you'll play your youth card, you'll play your energy card, you'll play your ambition card, if that's your game, right? Or you can get a job too. Okay, so this is youcanbook.me. Somebody was asking me. That's where you can make an appointment. All right, bear with me. So I know this is a very long day, but this is the way it is. I have to suffer through this, and that's why I showed you guys the video of the physicist, talking about and the matrix and the conjugate of this thing and that thing. So we have to listen to it for 3 hours. Okay. The next thing so we're going, tab by tab, right? Eventually, when you fill in all these tabs, onion, and you can defend all of them, then you will be at the right stage. So head count. Year 1, year 2, year 3, year 4, year 5. So one reason this class is kind of fun is, you're making something up. And the reason why it's not fun is because you have to defend the thing that you're making up. Because people will challenge you on it and ask you questions. So one area that you're going to make up and defend, so make it up in a reasonable, logical manner. In year 1, how many people will be working in your research and development department? How many in marketing? How many in sales, customer service, general and administrative? And because you will be either 2 people, 3 people, 4 people, you'll be doing everything at once. Quarter time sales, quarter time R&D, quarter time washing the dishes, quarter time cleaning the kitchen, and so on and so forth. You'll be doing everything in a startup. So the total head count, total compensation, average salary per employee, average revenue per employee, 0. Why am I interested in average revenue per employee? Average revenue the company is making per employee. That is because for every industry, regardless how big the company is, there is a typical standard average revenue per employee. So all the way, in my case, for example, my tiny little company, I think we had 16 employees at its peak. $300,000 in revenue per employee. GE Medical Systems, thousands and thousands of people working for them, same industry, medical device industry, $300,000 per employee in revenue. So you can't be way off. So when you project a revenue number for year 3, it has to be consistent with the rest of the data that you're giving us. How many people are working for you, to support that $300,000 revenue, and is it consistent with the rest of your industry? There are some outliers. For example, Craigslist, $1 million per employee in revenue. Huge. $1 million revenue per employee. So, but there are averages, and most companies are close to the average. So there's several reasons why we want to see this type of a layout. One reason is we're testing to see whether you took the time to think things through. Whether you're logical, rational, you can defend it, and another reason is to see the realism. Okay, so we're getting more and more complex now. Sensitivity analysis. So the bottom line is this. You're going to say, I have identified a market that is a very large market, $100 million a year, and Mr. Investor, in year number 5, we will capture 5% of that market, and that will determine, year 5 revenue, number of employees, cost of goods sold, blah, blah, bottom line. Are you interested? And I'm going to say, how do you know you're going to get 5% of the market in year 5? And honestly, you'll say, I made it up. Do you know what percent of the market I can get in year number 5? And if I'm honest, I'll say, I don't know either. We're both guessing, right? So what is then market share? Market share is a very critical percent market share versus profits, projected profits in year number 5. A graph of this. Now, imagine a graph of this. We know how big the market is. What we don't know is the market share that you'll be able to capture. Therefore, it's a variable. So you say, I think I'm going to capture 10% market share, and that will make us be a company that's making $1 million per year in profits. However, if we end up making 5% market share, then our company is going to lose $500,000 a year. And if we end up being very lucky at getting 25% market share, we're going to make some much higher profit, let's say $3 million in profit. So now the investor and you are looking at this and assessing, instead of waving hands, now we have given them a graph. This is the key variable, market share, and this is how my company is going to work out. Now again, even at this layer, this is the onion. Now let's peel off the layers. What happens in RIA, and this is what separates the men from the boys and the women from the girls in terms of entrepreneurship. So the real ones know that if the revenue is not showing up, everything is determined by what actual revenue is coming in. Suppose I projected, $400,000. Let's suppose I projected $4 million in revenue, but what ended up is I only got $2 million in revenue. Well, you know that I'm going to move to a smaller place and cut my rent expenses. I'm going to lay off a whole bunch of people and cut my labor expenses. So I'm going to react to the revenue. So therefore, this is not just a linear plot like this. Do you see what I'm saying? The costs and therefore the profit that you're making will be a function of the revenue. You'll adjust, like Clayton was saying. You adjust to reality as it reveals itself. You see what I mean? So a critical point. So this is the sensitivity analysis that we would like to see. If you capture 5% of the market, what will your net profit be? 10%, 20%? And the key thing is, this is not a linear relationship. If it was a straight line, I wouldn't bother asking you for this information because I can, calculate it in my head. What I want to see is how are you going to respond to having captured a smaller market share. Again, don't worry way too much about this if it's not crystal clear because we have lots of time to dig into the onion. Just trying to show you the top level. each of you, when selecting your venture concept, should think about this. Risk. High risk at the very top, and then diminishing risks for the success of the company, and how are you going to mitigate that particular risk. So what example do I give here? A better capitalized company comes up with a technology that's better and more efficient. We don't find the people with the right skill sets, blah blah. Material components, material costs could rise, threatening our overall costs. During pilot run, we uncovered technology issues that we were not aware of currently, etc., etc. Now, these sound so common sense to you now as you read them, I hope, but people have gone through. Tomorrow we have a Desert Angels screening committee meeting, and one group is going to present to us who has already used, I think, like $500,000. And they have not yet answered the top risk level question at all. I'm going to destroy them tomorrow. In fact, I'm planning on the questions that I'm going to ask them. After $500,000, they have not yet addressed the top risk item. So the capital efficient philosophy is the following. Again, pause for a second, drop Facebook. This is also really important. The capital efficient philosophy is this. We look at a company and we say, what is the highest risk item that you're facing now? For example, we do not yet know how much customer acquisition is going to cost. We will provide you with enough capital, just enough capital to answer, to eliminate, to mitigate that top risk item. That's efficient use of capital. There's no sense in going like to the fourth one down the line. So it will be your tasks to find out, to determine and to discuss what's the highest risk item that I'm facing now, that this venture concept is facing now. How much is it going to cost to mitigate that risk? And level by level, we'll keep mitigating the risk. And this is also called milestone-based investing. We will put in more money at a higher valuation. The more you prove out, the more you mitigate the risks. But each of you are going to be forced to identify, and you can't hide this stuff. So, you're going to say what the risks are because we know what the risks are. We expect you to know what the risks are. And then how are you going to mitigate them and defend against the attacks for not properly answering the mitigation strategy. This is something I laid out before. Use of funds. At one point or another, either you're going to use your own money, your parents' money, the government's money, somebody's money is going to have to be used to get this venture off the ground. And anybody smart who's parting with his money, I don't care how rich they are, if they value, if they respect the value of money, they're going to ask you. And if they respect themselves and respect you, because you're supposed to be indulgent, I'm supposed to be indulgent. Therefore, we should say, how are you going to spend the money? What are you going to spend it on? How much do you need for this item? What is the targeted milestone and the deliverable, the specific goal, and how long will it take you to accomplish this? I give you some money to do this, and you do it on time and deliverable and good results. Now you go and ask for more money. This is how you get to retain ownership of your company, and we're going to go into lots of detail about this. This is about how do entrepreneurs keep ownership of their company even though they need outside money. There's no sense neither for us nor for you. We don't want to own 80% of your company because you'll walk, right? Because then you'll feel like an employee. We want you to own 80% of the company yourself, and we want the company to be very successful so that the 20% gives some returns to us, but the 80% returns much higher value to you. Okay? So this is yet another thing. And then lastly, we talked a little bit, I think, during orientation maybe, the difference between lifestyle companies and companies that are designed for an exit. An exit means somebody acquires them. Now, investors would have I know I'm emphasizing investors, but I'm including you and your parents and everybody who comes up like the $35 an hour, a minute money. It's value. Value is being invested in you. I don't care who's making the investment. So now we have to return back that value to whoever put in the value. So if we create a lifestyle company in which you're making great revenues, and somebody put in, let's say, $50,000 to get this company started, and you're the CEO, you own 80% of the company, and you're traveling first class, and you're staying at 5-star hotels, but the people who put in the $50,000 are not seeing any of the money. All the profit is going back to the founders. In principle, that's an unfair situation, so the investors, when they're putting in their $50,000, they anticipate having a so-called liquidity event, the sale of the company, so that they get a return on their money, and so does the founder. This is a question of choice, essentially. So when I started my companies, every single one of them, the day I started them, how was I going to sell that company, and to whom, and at what price, and when, was already in my mind. I was